this is cash receipt schemes and other asset misappropriations. So they start out the chapter talking about the nonprofit that was set up to assist families of victims of September 11, 2001. And then anonymous tip alerted the board of misappropriations of funds. Corporate officers were using it for personal use, inconsistent records with vendors, 2 sets of financial records. Some transactions didn't appear in the original journals and ledgers, and unauthorized personal expenditures on credit. All those things are going on. And then, some people got caught up in all that. One moment. Okay, I got my beagle Eddie over here, and he's making some noise. I just wanted to see what he was up to. Okay, moving on. This chapter has, again, I'm going to shut down my camera so I'm not in the picture. There we go. This chapter has 6 modules. And first one examines the idea of cash skimming, when the fraudster absconds cash as it enters the business, but before it's entered in the company's books. Good stuff. Module 2 talks about accounts receivable skimming. Module 3 looks at just good old-fashioned cash larceny. A pure cash grab, as they say. Module 4 talks about non-cash asset misappropriation schemes. Module 5 looks into inventory issues. And Module 6 looks more carefully at fraudulent documentation used to conceal those non-cash appropriation of assets. So a lot to cover here, so let's get going. So number 1, Module 1, skimming schemes. Theft of cash from the victim entity prior to it being entered into the accounting system. Off-book fraud. As a result, there is no direct audit trail, okay? And it can occur at any point where funds enter into a business. That includes salespeople, tellers, wait staff, and others who receive cash directly from customers. We then subdivide it based on whether they target sales or receivables. Now, grabbing cash coming in on receivable, that's going to be a problem because the sale has already been recorded. If you can grab the cash right at the beginning, at the sales, before anything gets recorded, that makes it much more difficult to detect. Examples of check skimming. The fraud perpetrator files documents with the Secretary of State's office to create a new company called OSI LLC, an abbreviation of Office Supply Incorporated. The perpetrator can then apply for a tax ID number, and with both of those, they can go off to a bank and open an account. When checks arrive made out to Office Supply Inc., the perpetrator then takes the occasional check, deposits it in OSI, and the perpetrator then manages the accounts receivable from OSI associated with the missing check. A couple of years back, this happened in New York City with NBC, now NBC Universal. And a young guy with NBC there at 30 Rock decided to do something similar. He opened up an account at a bank in Brooklyn under the name NBCU. Again, doing the same thing, getting the documentation necessary to open up a bank account. But NBCU, supposedly short for NBC Universal. And so when checks would come in, especially if they were made out to NBCU, he would grab it and then take it over to this bank in Brooklyn and deposit it. And that was his private little slush fund. And he had the power in his position at NBC to write off accounts receivable as being uncollectible. So especially if it was like a one-time vendor, nobody would be too upset. Just write it off as uncollectible. And apparently this guy would use this money he was skimming to charter jets to the Caribbean on the weekends and fly down there and then fly back in time for work on Monday. Finally, somebody was like, for what we're paying him, he really couldn't be doing all that. And they kind of looked a little further, and that's what they found. And here we see the flow chart in the text on unrecorded sales. I'm going to ask you on your own time, if you would be so kind. I think you'll enjoy it. I've placed on the on Blackboard at the course content tab or page a couple of videos, and the first one, dealing with real skimming, is a clip from the movie Casino and the counting room skim. And this was when organized crime really owned the casinos, built the casinos in Las Vegas. And they would take the cash collected on the casino floor back to a counting room, as you'll see in the clip, stole it and did not report it. And that's how the mob made a lot of money in Las Vegas until eventually they were shut down by the federal government. As you can imagine, how difficult would it be to audit that? Especially, you would have to know exactly how much people bet in the casino, and then track it back to how much was being recorded. One of the things that casinos now use is they have the various players clubs and such that you're free to be a member. That's a great way for the casinos to know exactly how much money is being dropped in the casino. So it's a great control feature as well. I apologize for some of the language. It was from the movie Casino, so some of the language is a little rough, but I think it shows you how Las Vegas got built up off of this skim in many ways that the mob was taking. Eventually, as I say, federal prosecutors went after the mob, but what eventually drove the mob out of Las Vegas was corporations. When MGM, the movie studio, decided that they could make more money in gambling than in movies, and they built the MGM Grand, and now they own a number of casinos out there. Bally's started out in Chicago making pinball machines and then slot machines, and then they got into the casino business. And then you've got Caesars and a few others that control the vast majority of casino gambling in the United States. So big business, corporations, is what eventually drove organized crime out of Las Vegas. Also on the course content page are two videos about Crazy Eddie. Crazy Eddie was a retail electronics firm in the tri-state area of Connecticut, New York, and New Jersey. And both of them tell this story. And they started out doing skimming. When people would purchase goods in cash, I'm told, and Sam Antar, who's featured in this, I've gotten to know, they would simply ring up the sale on a separate cash register, but then never record those sales. They would just keep the cash. And to, as you will see, they, would create, or they would keep, help someone out to their car with their new stereo or television, unpack it, put it in the back seat of their car, and then bring the box back in and seal it up and stick it in their warehouse so it looked like it had never been sold. So their inventory always matched up with the skim. Anyhow, watch those videos. I think you will enjoy them. And as I say, they're quite enjoyable. Okay, moving on. So there's a great flow chart. It's in your book. Take a look at it, and I think you'll see all the various schemes that we've come under the unrecorded sales scheme. So Sales skimming. Most basic skimming scheme occurs when an employee makes a sale of goods or services to a customer, collects the customer's payment at the point of sale, but never records it. Okay, this can happen in department stores is where they've often had a problem, where a sales clerk will be out on the sales floor, somebody's buying stuff, and they'll say, well, tell you what, in fact, I saw a court case involving it and said, we've got a special discount, manager's discount, 25% off if you pay cash. That's great. So while the customer is on the sales floor, before they come to the cash register, they take the cash and say, tell you what, you keep shopping, I'll ring this up for you. And what they do is they go back, put the merchandise in a bag, fold it up real good, and bring it back to the customer with their change that they made out of their own pocket, and never record the sale at all. And in a large retail situation, especially if they don't have really good inventory control, nobody knows that the customer is walking out with the merchandise that they paid for but never got recorded. By the way, interesting little trivia thing, very often you go into a store and the price of something is like, $4.99 or $4.95 or $12.95, not $12 even or $15 even. Why is that? That is actually a very early fraud detection matter, because by making it an odd number, it almost forces the salesperson to go back to the cash register and ring it up in order to get the change necessary to make the customer happy. So by making it not an even amount, it encourages or forces the salesperson to ring up the sale. So it's when you see those amounts, realize that was in order to encourage or discourage fraud. Okay, so here are some of the topics we're going to talk about: cash register manipulation, after-hour sales, off-site employees, poor collection practices, understated sales, the check for currency substitution, and theft in the mailroom. Okay, so right off, cash register manipulation. Okay, most difficult part of a skimming scheme at the cash register is the overt act of taking the money. Okay, just open up the cash register and take out money. Well, at the end of the day, they're going to reconcile the cash in the cash drawer with how much was there at the beginning of the day and then what the sales were. And it should all balance out. Well, to conceal the theft, the employee might ring a no sale or other non-cash transaction on the register. So the customer's there. What do? You ring up something. Oh, it's a no sale. Customer doesn't know that's what they said. And the sale never gets recorded. But then the employee, the clerk, pockets the cash. In other cases, employees will rig the cash register so that sales are not printed on the register tape. Difficult with modern cash registers, known as point of sale terminals, because they're all electronic. It's all hooked into a real-time data collection system, so it gets recorded immediately. So it's not so much dependent on a cash sales tape. But there are various ways of manipulating the system to get around this. Let's see. As I said, sometimes you just one I heard was interesting. As I say, at the end of the day, the employee the clerk is to carry or take their cash drawer up to the offices of the store, say a big department store, and then it's reconciled. There are folks there will count up the cash that's in the cash drawer, and then compare it to the amount of sales, compare it to the cash that was in the drawer at the beginning of the day, and add it up and see if the cash in the drawer reconciles to what should be in there. Okay. And then the cash drawer is to be put into the safe, department store safe, until the next business day. Well, this one store was undergoing some renovations, and so they had the reconciliation department at one side of a floor, but the safe was on the other side of the floor. And so clerks would come up, they'd do the reconciliation, and they'd be told, okay, everything's here that's supposed to be here, and then hand the cash drawer back to the clerk to walk it across the floor. Well, they found they were losing a lot of cash. Well, in that trip, that walk across the floor, sales clerks were simply pocketing cash out of the cash drawer. So if you're doing reconciliation, you should not hand the cash drawer back to the person. Okay, it should immediately go into the safe. Okay, well, another one of the schemes that goes on. After hour sales. Oh, this is a fun one. Conducting sales during non-business hours. And these off-book sales create not only a cash shortage, but an inventory shortage as well. However, inventory shrinkage can be the result of damaged goods, not removed from inventory lost in shipping, and of course, theft by non-employees. That is to say, shoplifting and other reasons. One story I heard was a guy who owned a store, came back, went away for vacation, comes back, everything seems to be fine, happens to run into somebody he knows who tells him, you know what, I want to thank you. I got such a good deal on a snowblower during your Midnight Madness sale. And the store owner was like, Midnight Madness sale? Yeah, about a week ago. Yeah, your store was open at midnight. They had everything like, 50% off. I got a great deal on a snowblower. Sure enough, while he was gone, some of the employees got together, unlocked the store, and put some signs around, calling for this Midnight Madness sale. Customers came in, bought things for 50% off, and none of those sales ever got recorded. All the cash got kept by the employees. Oh, and it had to be a cash sale too. Okay. By the way, if you ever hear a place saying, or somebody saying, oh yeah, big discount if it's a cash sale, that's probably a fraud. As I said, I was in a court in downtown Chicago some years back. I heard the case of a guy who went into a Sears store back when those were around, went into the tire department to buy some snow tires for his car. And he was approached by a salesperson who said, hey, by the way, big sale on this, 50% off, but only if you pay cash. Well, the guy said, I don't really have a lot of cash. And so the salesperson conveniently directed him to an ATM that was in the store. Went to the ATM, got the cash, gave the cash to the salesperson. Salesperson says, okay, now go out to your car, bring it around to service bay number 3, and tell them Bob sent you out there, and I'll have the paperwork out there, so we'll get those tires on your car. Great. Well, security cameras show as the customer went out to get his car, Bob, the sales clerk, walked out the door with the cash. Turns out Bob didn't work for the company at all. He was a fraudster who pretended he worked for them and took the guy's cash. The guy pulls up at the service bay, and guess what? They had no idea who they were talking about. They had no paperwork of a sale of snow tires. The customer sued Sears, and what the judge asked the ripped off customer was, did Bob, was he wearing anything to indicate that he was a salesperson? Back in the day, Sears, the salespeople would wear like either blue or red vests in the hardware or auto departments, or they'd have a name tag on. And to his credit, the customer said, no, he did not. To which point the judge said, well, we can't really then hold Sears responsible. Had they left some vests or name tags around that somebody could pick up and put on and pretend to be a salesperson, that would be one thing. The store might be responsible. But in this case, no, You just got ripped off by somebody who didn't work at Sears, who just claimed it and had no indication of it. Sears was not held liable. So there you go. Moving on. Skimming by off-site employees, and these can be sad. It says employees who work at remote locations or without close supervision perpetrate some of the costliest skimming schemes. Several cases involve the skimming of sales by off-site employees. Some of the best examples occur in apartment rental industry, where apartment managers handle day-to-day operation without much oversight. That even takes place in real estate sales, where, say, somebody is moving out of town. They move out of town. They leave a real estate agent in charge of their property to supposedly be selling it, but instead they rent it out, and people move in, pay rent for a couple of months, and the real estate agent keeps all the rent money, isn't really trying to sell the thing at all, and keeps telling the people who have now moved out of state, oh, well, it's been a really bad market for house sales. And so that's one. One of the worst, as I said, also a property manager skim payments made by tenants for application fees and late fees. One of the worst has dealt with a off-site insurance salesman who sold life insurance policies, would keep the premiums, but never place the policies with the insurance company. And it went great for a while until somebody dies, and then they try to collect the life insurance and are told by the life insurance company that they have no policy for that person. And so for a number of years, they're paying monthly insurance premiums for a life insurance policy that never got placed. And then when the person dies and they need the funds, they're not there because they've been stolen by that insurance agent. So any kind of off-site person involved in sales can perpetrate this type of fraud without the appropriate controls. Okay, poor collection procedures and recording procedures can make it easy for an employee to skim sales or receivables. Such as things like failing to itemize daily receipts is a common problem. Another one with regards to receivables is don't put the person in charge of collection, don't also give them the power to write off accounts, because then, and we've seen cases of this in the millions of dollars, where they, again, for a vendor, maybe it's a one-time customer, they go to the customer and say, look, rather than you having to pay the full amount, I'll let you pay 75%, 50% on the dollar, okay, 50 cents on the dollar, just to make it go away. They pay the money. The fraudster employee keeps the money and then goes back to the company and says, look, there's no way I can collect on this. They're just a bunch of deadbeats. We're going to have to write the account off, and writes the account off. So you've got to keep that separate, the one who collects or is trying to do the collections from the person who has the power to write off an account. So here's a flow chart for understated sales, much like stolen sales, but you just lower the amount and you pocket the difference. Okay. A check for currency substitution is you take an unrecorded check that the perpetrator has stolen and substitute them for receipted currency. So a check comes in, the employee grabs that check, another customer comes in, pays cash. Okay. Employee pockets the cash and then puts the stolen check in its place. The numbers all balance. So this is especially common when the fraudster has access to incoming funds from an unusual source. Okay. Sometimes the funds are dropped off at the at the receiving dock or the delivery dock or the pickup dock, and rather than at the at a cash register. Now, theft in the mailroom of incoming checks. Another common form of skimming occurs in the mailroom, where employees charged with opening the daily mail simply take the incoming checks instead of processing them. When the task of receiving and recording incoming payments is left to a single person, it's all too easy for that employee to slip an occasional check into his or her pocket. Again, this is especially problematic in small businesses where you have, for example, the office manager who is in charge of all of that stuff. Unfortunately, I knew someone who was an adjunct professor at a different university of accounting who had a tax preparation and accounting firm and had an office manager who he relied upon and trusted. Well, she would pocket the checks and then write off accounts. And eventually, she also did not pay the IRS for taxes owed. It was the IRS who came a-calling, and that's when the scheme fell apart. But yeah, incoming checks and then write off the receivable, or there are other ways of just continuing the receivables on the books, but not letting it be shown. All right. Now, fortunately, we're at a point in our society where, if you go back some decades, small business especially had a manual paper-based accounting system. Then you went with, as opposed to a computerized system. Most, even the smallest businesses have a computerized system. But if you have a mixed use system with some computerized, some old-fashioned, paper trail, paper-based system, maybe for nostalgia purposes, they have a cash register, the old-fashioned cash register that you ring up and issues paper, has a paper roll in it to record sales, or maybe they write things up on paper. You hardly see that anymore. But in places that still have that, those systems can be exploited rather easily. Computerized transactions require adjustments in order for the scheme to succeed in both the act of stealing and in the concealment. Concealment is what hangs up most fraudsters. Now, if you have the interface between manual and computer system, that creates new opportunities for the fraudster to facilitate and conceal the bad act. So maybe, they have a computerized system, but somebody has to enter the numbers from the paper system into the computerized system. Well, that person can pocket the checks without recording them, etc., etc. So those are fraught with danger, the mixed systems. So how do we prevent and detect sales skimming? Viable oversight presence when cash enters the organization. Okay, so management keeps an eye on things. Cluster your registers together so there's always somebody watching. Video cameras, and as I point out, if you go to a store and you see a video camera behind the cash register or behind the checkout area, except in the case of, say, a convenience store, or as my police friends would call them, the stop and robs, the cameras are not pointed at the customer. They're pointed at the clerk to make sure that the clerk is ringing up the sale appropriately. And it can be so much as in stores now where you have scanners that scan the barcode, and make sure that they scan every item and not just a few. Common practice if a friend comes through the store and you're working the cash register and they've got, 6 video games. And so you scan 3 of them but you put all 6 into the bag, and then your friend walks out with 3 free ones. But most stores have, as I said, the video cameras pointed at the clerk. I think at this point, most stores, they point at both. Okay. Again, I have a former student who became the head of security at a casino, and casinos have cameras everywhere, and they are good. They can watch a card dealer and know exactly if they're manipulating the cards and things like that. They have some really fine equipment. Let's see. Also, customer complaints and tips. Especially if you get complaints from folks that say, I never received a receipt for my purchase. Well, that may be because it was never really rung up. A lot of stores will, fast food places and such, will have a sign. Remember the old Boston Market chain used to have a sign that said, if you don't get a receipt, you get a free cookie. And I was always hoping I wouldn't get a receipt, but they always gave me one, just so I could get that free cookie. The idea being, you're now bringing the customer in on the fraud prevention. The customer will look to get that receipt. But if you're getting complaints that people aren't getting receipts, okay, then I think you have a problem. Cash register login and log out times. That way you know who had access to that cash register during those times, and be good with the logging in and logging out. And for goodness sakes, don't do what I've seen at retail locations where they've got the post-it note on the cash register with the different login codes for the different employees. Because if one of those employees is dishonest, they will simply log in under one of their fellow employees' numbers and steal the cash then. And especially if it's on the bad employee's day off, they come in, they walk behind the cash register, nobody thinks anything of it, they open it up using the other employee's number and walk out with the cash. So log in and log out on point of sales terminals are great. Again, those off-site personnel, the best thing we can offer is activity logs where they show that they've, what they've been up to. But, frankly, it's not that great a control. Okay, so they put down that they made a sale or that they, were trying to make sales and they didn't. Well, maybe they did make a sale, but they just didn't record it. So it's not the greatest control, but it's better than nothing, I guess. And reduce the perceived opportunity to steal. The key there is that word perceived. And again goes to the idea of deterrence, playing with people's heads. Okay, so if people think they won't get away with it, they might be the most, theft-prone employee you have, but they won't do it if they think they will get caught. So at least 2 employees should be involved with opening the mail and logging in incoming payments, because that way they at least are going to have to collude with each other, and hopefully they won't both agree on doing it. Okay. Each of these modules at the end has a couple of slides on big data and data analytics. I'm going to go real quickly on each of these. They have some great tips on how to use data analytics to look for those anomalies, to look for those red flags that might indicate that there is some sort of fraud being perpetrated. As states here, most registers are now electronically connected to a computer system that records not only traditional transaction information, but also date and timestamps, ISPs and other information. And data analytics and big data techniques can be used to highlight anomalous transaction activity across time, location, employee, by terminal, and so on. So if there's one employee who's bringing up more no sales or returns than any other, your data analytics will find that out. Now, maybe they are the one salesperson who who looks friendly enough to bring a return to, or maybe they're ripping off the company. And as we delve further into AI, artificial intelligence, that can be set up to look for this sort of information instantaneously. So the data analytics using AI is going to change this remarkably much. Okay, what about those receivables? Again, they're more difficult than skimming sales because by nature, something has already been logged into the accounting system. Okay, it's the receivable payment that won't get logged in. So then you're going to have this outstanding receivable on the books. If this is a regular customer, they're going to get a monthly statement and they're going to wonder why. Hey, why don't you show that payment that we made? So when fraudsters attempt to skim receivables, they usually use one of these techniques to conceal the theft: lapping, force balancing, stolen statements, fraudulent write-offs or discounts, debiting the wrong account, destroying or altering records of the transaction. Okay, let's talk about lapping. Okay, one of the most common methods is lapping, crediting one account through the abstraction of money from another account, robbing Peter to pay Paul. So, for example, a payment comes in from customer A one day for $500. You pocket it. The next day, a new customer, customer B, sends in a payment of $500. Apply customer B's $500 to customer A's account, and now customer B shows an outstanding amount of $500. Well, fortunately, on day 3, customer C sends in a payment of $800. Well, take $500 of that, apply it to customer B's account. Now customer B shows a zero balance. And what the heck, that extra $300, pocket that as well. So now you've got customer C with an $800 outstanding balance. Well, fortunately, on the next day, customer D sends in an $800 balance, $800 payment. Apply that to customer C. So you see why they call it lapping, okay? So this sort of situation continues until someone discovers the scheme, restitution is made to the accounts, and some concealing entry is made to adjust the accounts receivable balances. Lapping could also be used to disguise skimming of sales. It's essentially a Ponzi scheme, contains essential elements of lapping, taking money in from one person, paying it out to somebody else. Okay. Force balancing, just make the numbers look like they add up. Among the most dangerous receivable skimming schemes are those where the perpetrator is in charge of both collecting and posting the payment. If a fraudster has hand in both, both ends of the receiving process. One of the little cool things you can do if you ever want to, just as a prank, on an Excel spreadsheet, you can list a bunch of numbers and then have the sum at the bottom. Okay, it looks like it adds up. Well, take that top number and change the color of the characters to white. Well, now you can't make out the numbers because it matches the background. And so say that first number was $500. If you were dealing with receivable payments, you could have that $500, change the color, and it disappears. The total would look like, so then you reduce it from the bottom. Everything looks like it adds up great. So you can use Excel by changing the color of the characters to match the background, match the quote paper. You can make a payment disappear and then you pocket it. Okay. But force balancing, if you have a long column of numbers, most people are not going to sit down and add them up. If it looks reasonable, okay, close enough. So that's where you can just put down the number that equals the amount of the deposit you made to the bank for sales for that day, and everybody's happy, even if those numbers in that column actually don't add up to that bottom line number. Stolen statement, as I say, when that customer's money has been stolen and their account hasn't been reduced, when they get their monthly statement, they're going to see, hey, my payment didn't come through. You know, what's going on? They're going to complain. So, as I say, if customers' payments are stolen and not posted, their account will be then made delinquent. And then they're going to get notices that you're past due. So if you're the person, you know, you have access to the mailroom, well, just go down to the mailroom and steal the statement before it goes out. Destroy it, or go into the computer system, change the address for that customer to an address that you control, whether that be your home address, which would be kind of dumb, or say a mailbox, either at a post office or at a say like a UPS store, where they have mailboxes you can rent. Or one I saw was in a neighborhood you might have. There was one guy who had he owned an apartment building, and the apartment building had, you know, the little mailboxes on the wall for each of the apartments. It included a couple of mailboxes for apartments that didn't really exist. We used that address, and so had the mail stuff put in there. He controlled the mailroom, so he was able to have mail delivered to a non-existent address. Or even better, if there's an abandoned house down the street from you, go to Home Depot, buy a mailbox, hang it on that house, and have mail delivered to it. And that could be from those customers. Those delinquent statements are going to this abandoned house, and the customer doesn't realize that their payment never was posted. Again, if you are the person who is in charge of writing off accounts, hey, this is, and collecting, this is for you. Intercept the customer statements, keeps the customer in the dark, but the problem still remains that as long as the customer's payments are being skimmed, their accounts are slipping further and further past due. Lapping is one solution. Another is simply write off the customer's accounts fraudulently. Some employees cover their skimming by posting entries to contra revenue accounts such as discounts and allowances. So you don't really just write them off as deadbeats. You give them a discount or an allowance. And customer's account balance goes down to zero. You've got the money in your pocket, and your company's accounts all balance out. Debit the wrong account. You can also debit existing or even fictitious accounts receivable in order to conceal the skimmed cash. The employees who use this method generally add the skimmed balances to accounts that are either very large or aging and are about to be written off anyhow. Rather than existing accounts, some fraudsters set up completely fictitious accounts and debit them for the cost of the skimmed receivables. And then when worse comes to worse, destroy the records. When all else fails, a perpetrator may simply destroy the organization's accounting records in order to cover his or her tracks. So the company will, know that, they've been ripped off, but by destroying the records, they might not be able to trace it back to the employee who perpetrated it. So cash register tapes may be destroyed to hide an off-book sale. Discarding transaction records is often the last-ditch method for a fraudster to escape detection. So the fraud gets detected, but who's responsible might be able to get away with it. Or at least, let's put it this way, they might think it's you, they might fire you, but they might not have the evidence to prosecute you. Again, ways of preventing and detecting receivable skimming: good internal controls, separation of duties, which again is so hard in small businesses. You just don't have the personnel to separate all these duties. But regular rotation of job duties, that can help. Might be a small business, but then somebody can't perpetrate it for a long period of time, because when they get rotated out, the next person will discover what's been going on. Make your employees take those yearly vacations and have somebody cover their desk while they're gone. Supervisor approval for all write-offs or discounts, a properly trained audit staff, automated testing, again using our data analytics, and trend analysis on aging customer accounts. The third from the bottom, a properly trained audit staff. Just the presence of an internal audit department will often deter a lot of fraud schemes within a business. And here again, big data and data analytic techniques, and it gives off a whole bunch of good ideas that you can have the your IT system in your company run these searches, and that can, again, it can indicate anomalies, can indicate red flags. Doesn't necessarily mean there's a fraud occurring, okay? But it will give you an idea if there is an anomaly to investigate further. Here's some more on that and more on that. Okay. Cash larceny schemes. So cash receipt schemes fall into two categories: skimming and cash larceny. Larceny is just outright stealing, the intentional taking away of an employee's cash without consent and against the employer's will. Money has already appeared on the victim's books, can take place whenever an employee has access to cash. Most larceny schemes involve the theft of cash either at the point of sale, from the incoming receivables, or from bank deposits. When I think of that, I always remember the movie It's a Wonderful Life, if any of you remember that. And there's a scene where Uncle Billy is taking the cash down to Old Man Potter's bank to deposit it from the Bailey Building and Loan, and he leaves it behind. But stealing from a deposit, now Billy was just negligent. He wasn't attempting to steal, but somebody with a more evil motive would do that. All right, a point of sale. Large percentage of cash larceny schemes occur at the point of sale because that's where the money is. How do you conceal it? Well, steal from other registers. So there's a couple of registers put together. You're in charge of register number 1, and the person in charge of register number 2 goes on their lunch break, and you know the code to go into it. Okay, take $500 out of your register, go over to their register, take the money out of there, stick it back in yours, or just go over to their register, take their money. Death by 1,000 cuts is the idea of, like, okay, most stores have limits on how much you can lose before you are terminated. But so you steal $20 today and $20 tomorrow and $30 the day after that, and they're small enough that they get written off as, well, there were a lot of transactions and things happen. Okay, great. So rather than doing one big theft, you do a lot of little ones. Okay. Reversing transactions. Again, somebody buys something, say they pay cash, $100 cash, great. You ring it up, fine. They walk away, and then you ring up a return. And there was no return, but it's the sale gets removed from the books. The merchandise is gone, but again, unless you've got really top-notch inventory control system, it won't get noticed. It'll be written off as inventory shrinkage. Altering cash counts or cash register tapes, simply changing the numbers and when it comes time to reconcile. And again, destroying the register tapes, again, last ditch when you're about to be caught. Here we have the different schemes in a graphic form. So I was saying, theft from other registers, steal it from somebody else's cash register. So not a great way. Again, keep those access codes hidden. Do not share them amongst employees. Okay. Death by 1,000 cuts, again, takes small amounts over a long period of time. Again, the third bullet point, most organizations track overages or shortages by employees, making the method largely ineffectual. Especially for a new employee, if if you go over a certain amount or have a number of shortages within a given period, then you are going to be let go. What's interesting, statistically, if this is just mistakes, you would expect that the overages and shortages would balance out. Well, not really, because overages mean that the customer did not receive enough cash back on the transaction. Well, if that happens, the customer will usually complain and get their money back. That's but if the customer gets more money than expected, in change, sadly, most customers won't return the excess. They'll just pocket it. So as a result, you get more shortages than you ever get overages. Reversing transactions, another way is conceal it using false voids or refunds. This causes the register tape to reconcile the amount of cash on hand after the theft. A lot of stores, to do a refund, you need to bring back the receipt. One of the reasons that places also want you bring the customer in to make sure you get the receipt, and they'll put a sign up, no returns without the receipt, to make sure you get the receipt. So otherwise, the clerk can put your merchandise in the bag, roll it up, hand it to you, but pocket the receipt, and then a couple of hours, a couple of days later, use that receipt to process a refund, and then they pocket the refund. Altering cash counts or cash register tape, destroying the tapes. Again, you simply alter the amounts. If nobody is double checking it, nobody's going to know. Instead of altering cash counts, bullet point 3, some employees will manually alter the register tape. If you cannot make the cash and tape balance, the next best thing is simply destroy the tape. Spill your coffee on it or whatever. But again, this goes to the paper-based cash registers that aren't a point of sale terminal. You don't see too many of those around anymore. How do you stop this? Strong internal controls, segregation of duties, watching for discrepancies between the sales records and cash on hand, and then do an analysis on discounts, returns, adjustments, and these other sort of concealing transactions. Again, larceny of the receivables, customer mails in their payment and it gets stolen. One of the reasons, very often you'll see, if you get a bill, they'll say, do not send cash. It's not that they're trying to make you, pay online or pay with a check, because if you send in cash, it's just too tempting to steal it. So don't do that. So you need to steal that incoming payment and you hide the imbalance through either forced balancing, reversing entries, or, as I say, destroy the records. Forced balancing, fraudsters who have total control of the company's accounting system can simply overcome the problem of out-of-balance accounts. Again, this is due to poor separation of duties or no separation of duties at all. Again, small businesses where you have that one office manager who handles everything. Again, there's also the reversing entries where the payment is stolen, nonetheless posted the cash receipts journal. The reversing entry can be used to balance the victim company's account. Destroying the records does not prevent the victim company from being robbed, but it helps conceal the identity of the fraudster. Again, you have a place sending their receivables, checks in cash, to the bank to be deposited. And please, please, please send the money in every day. Most banks will have, either an ATM, or if it's large enough, they'll give you a key to a night depository where you drive up to the side of the bank building. You open up the big drawer with a key. You drop it in, close the drawer. It gets dropped into a secure box inside the bank. Don't hang on to it in your desk overnight, or bring it in at the end of the week. Get it in right away. Taking money prior to depositing it, often difficult to conceal. I saw one place, though, they would put the deposit going to the bank at the receptionist's desk and just leave it there on the desk. At the end of the day, somebody would take it and bring it to the bank. But then if the receptionist took a coffee break, oops, anybody could walk by and grab that deposit. Not too smart. Deposit lapping. Employee steals the deposit on the first day, replaces it with deposit on day 2. I mentioned this before. And then deposits in transit. When you are doing a bank reconciliation on the monthly bank statement, this is what you use to carry the missing money as a deposit in transit. Well, okay, but a deposit in transit should not be showing up more than once, okay? You're not sending the money to the bank via Pony Express. Get it, deposit it. And if it's not taken care of by the next monthly statement, you got a problem. Okay. Again, how do you prevent this? Separation of duties. Get an itemized deposit slip. Make copies of it. Send one with the person to the bank. A deposit slip's made out. One copy is retained at the business. The other goes with the bank, and then the bank, once they count the money, will stamp it and give a copy back to the person, or give you a deposit receipt. And then when they returned, compare that copy of the deposit ticket with the receipt to show that the amount that went off to the bank equals the amount that was received at the bank. And then deliver 2 copies of the bank statement to different people in the organization. I don't see that happening too much. The key, though, is to have the separation of duties so that you don't have the same person receiving the bank statement who's also handling all the bank transactions. Makes it just way too easy to cover things up. Here again, some tips on using data analytics. Using your IT system to look for those anomalies and red flags. 2 slides on that. And what about non-cash misappropriation schemes? Sure. We have all sorts of ways of doing it. Now, we talked about skimming at the beginning of this chapter, and as I say, if you watch that video clip from the movie Casino, that's classic cash skimming. But we also talk about skimmers or skimming, where a device will be placed on an ATM, or even say a gas pump or whatever, so that when you slide your credit card or debit card into that ATM, the code on the magnetic stripe is recorded. Now, fortunately, we are getting away from the magnetic stripes and into the chips, as you know from your credit cards. We are, I think it's the US and South Korea are like the only countries that still put magnetic strips on our credit cards. So you may notice lately, most credit cards do not have that magnetic strip or magnetic stripe. But a skimmer reads that information and then can use that to fraudulently get into the account. You also, for ATM theft, also need to get the PIN. Well, you can put a overlay over the keys so that the person is entering the PIN. It also gets recorded and transacted. So that's a second type of skim that we talk about. As according to media reports, the 2017 Labor Day weekend, Florida Department of Agriculture and Consumer Services warned that it found 382 skimmers on gas pumps in Florida. So, yeah, now that's changing too. Most gas pumps now do not read magnetic stripes. They only read the chips, which is good. Chips are much more difficult to crack, if you will, than just the magnetic stripes that just have the account information on them. So again, tips with regards to that term skimming. We talk about classic cash skimming. That's casino. This is a skimmer, a device placed on a ATM or a point of sale. Okay, so tips. Do an external check of the ATM or gas pump area. When folks go to, say, put these skimmers on gas stations, they generally put them only on the pumps furthest away from where the window is, where a clerk can watch them. Tug at any protruding parts. Check the keyboard. Look for a security seal that shows that nobody broke into the device to place a what it would be is a recording device to record the account numbers and such. Check for wires, damage or broken locks. Look for suspicious devices. Use a bank access code if available. Cover your hand while entering the PIN to avoid cameras, because a little tiny pinhole camera. Oh, I used to go on TV programs in Chicago and show off the little tiny cameras that could be placed to record your PIN as you were entering it by simply taking a picture. Well, another thing, when you use an ATM, I'll get to let me finish this off. A gas station, use cash or credit card. Yeah, use a credit card, not a debit card if you can. Debit cards do not have as many protections under the law that credit cards do. Again, use a pump in direct view of the cashier. Okay. Also, when you're in an ATM and you're punching in your PIN, you'd be amazed how many people mouth the words of the numbers on their PIN. Okay, and all you have to do then is place the camera to look at the person, and you see them, mouthing, 3917 or whatever. Yep, there you go. So don't do that. Okay, what about misusing non-cash assets? Oh, vehicles. It's usually a big one there. Okay. Misuse, unconcealed larceny, asset requisitions and transfers, purchasing and receiving schemes, fraudulent shipments. There are essentially two ways a person can misappropriate a company asset. You can borrow it. Okay, so let's say on the weekend, you have a separate business where you repair people's driveways. Your company happens to have, heavy equipment to do that. Well, you borrow it on the weekend to make money, even though it's competing with your company. Or it can just be outright stolen. You just take the equipment and never give it back. We see that, as I say, very often vehicles are big on this, but also computers are big. Computer supplies and office equipment can be used by some employees to do personal work on company time. Or, the big thing is using them to run a side business, especially, so if you're running a side business, that's bad enough. If you're doing it on time when you're supposed to be working for the company. But if you're doing a side business that directly competes with the company, that's really bad. Again, is that often competes with the employers for business. The cost of inventory misuse, difficult to quantify, may be seen by an individual as borrowing. Misuse schemes can be minor, or they can be very costly, especially if it's a very large piece of equipment that can be damaged. Using company equipment to operate a side business during work hours lowers productivity, can increase the competition the company faces. And when you borrow company properties, no guarantee that you'll bring it back or bring it back in good shape. Unconcealed larceny, you take the property from the company premises without attempting to conceal it. You just take the stuff. Losses can run into the millions of dollars. We see this as all sorts of different companies. Of course, retail has that a lot, but one of the things you'll see in a lot of offices and retail locations is the garbage cans will have clear plastic garbage can liners. Why clear plastic? Because one of the schemes is to, oh, look, there's a laptop computer, drop it in the trash. Or, hey, I'm in a retail store, there's a fur coat I like, put in the trash. If it's an opaque bag, it gets taken down to the dumpster. Then you do a little dumpster diving that night, pull it out, and it's yours. Okay? If you in downtown Chicago, I've noticed, well, actually noticed this a number of retail stores, they have big security cameras pointed at the dumpsters. Why? Because if somebody tries doing that, throwing it out and then retrieving it, they'll get you on camera. Another way of doing it is, say, for a laptop computer, get a FedEx box. Grab that computer off somebody else's desk, stick it in the FedEx box, and ship it to yourself, but not at your home address, but an address that you control. So take company assets without trying to justify the absence. Most non-cash larceny schemes are committed by employees with access to inventory. Employees often take items openly during business hours in plain view of coworkers. There's a management versus labor mentality, or it's sort of it's free money mentality, and it is really not hurting anyone. It's a victimless crime. Another is to do a fake sale. The inventory was not in fact sold, but you ring it up as if it were. Here's a non-cash larceny chart. And the fake sale, many organizations, corrupt employees will utilize outside accomplishments to help steal an organization's property. A fake sale occurs when the accomplice of the employee fraudster buys merchandise, but the employee does not ring up the sale, and the accomplice takes the merchandise without making any payment. The accomplices are also sometimes used to return the inventory that employees have stolen. It became quite a thing a few years ago with Walmart, where folks would come in, and I mentioned it before, they were getting hit hard with regards to music and also video games. And somebody would come in with and want to buy 8 video games. They'd bring it to their friend at the checkout stand, checkout counter, but they would only scan, 2 or 3 of them, but put all 8 into the bag, and off they went. Or better yet, you take 8 of them, 2 of each. So you have 4 different titles, 2 of each. You pay for 4 of them. We got a receipt that's got the names of those other 4 that you didn't pay for. And you take that receipt and the 4 you didn't pay for to a different Walmart location and return them for cash or credit on your credit card. So that's how you can turn that stolen merchandise back into cash. Again, through the fake sale approach. How do you stop it? Again, segregating duties and requisitioning, purchasing, receiving. Physical controls. Merchandise in the back should be, guarded and locked. Put it in, cages, especially the more high-end stuff. Restrict access to authorized personnel. Security cameras, especially ones that record it, ones, that will actually, not the old black and white grainy ones. Put in some newer generation video cameras. Do physical inventory counts on a periodic basis. Don't just rely on your, your computer-based inventory system, okay, the perpetual inventory. Take physical inventory counts and do not do them on dates that are regularly scheduled. Do it on a surprise basis. And then have a mechanism for receiving customer complaints. Again, not only just receiving the complaints, but then acting on them. One of the things you do in addition to having the mechanism to receive the customer complaints, have a customer service call, so that if you believe that some merchandise was sold to someone but was actually stolen by an employee, call that customer who supposedly bought it and say, so how you liking your new dishwasher? I didn't buy a dishwasher. There you go. And now you're onto something. Asset requisitions and transfers. Okay, so let's say you're a construction company. Well, you're going to do a job out at a site. A requisition will be made for the supplies that are needed, for the tools, the equipment, but mostly, let's say, concrete, gravel, asphalt, things like that. So in order to do that, you have to fill out a requisition form, and internal documents will be necessary to gain access to the merchandise. Move the non-cash assets from one location to another. And really, this can be for retail merchandise as well. Just move the stuff around. Just keep moving it around, and then at one point, it goes missing, and nobody really knows where it happened. The most basic scheme occurs when an employee requisitions material to complete a work-related project and then steals the material. Or, as it says in the next one, overstate the amount that's going to be needed and pilfer the excess. I mentioned before, the employee that has a side gig on the weekends of, say, repairing people's driveways. So, order more asphalt than the job could possibly use, and then take off with the rest. Or maybe you build garages on the weekend. Well, okay, order excess lumber and siding, and be sure to bring your van to work every day and stick a few pieces in the back of the van. Falsify forms, remove those non-cash assets in the warehouse or stockroom, and they're gone. Purchasing and receiving schemes. They're used to facilitate theft of non-cash assets, such as false billing. Purchase merchandise that the company does not, in fact, need. So, but you need it. Maybe you need an extra. You want a new computer at home. Okay, so you have the company buy it. Then the non-cash misappropriation, intentionally purchase it, but then misappropriate. So you order that computer for your department, and when it shows up, you stick it in that FedEx box and you ship it to an address that you have access to. Falsify the incoming shipments. One of the most common ways to abuse the purchasing and receiving function is for the person charged with receiving the goods on behalf of the company to falsify the records, or reject, or say, no, we received 30 laptop computers, but one of them was rejected, so was damaged, so we rejected it. Did you really, or did you just stick it in your car? The most obvious problem with this kind of scheme is that if the receiving report doesn't match the vendor's invoice, there's going to be a problem with the payment, but only if the accounts payable department does its work and matches receiving reports to invoices. If they don't, if they just, go ahead and pay the invoice, nobody's the wiser. As regards false shipments of inventory and other assets, fraudster creates a false shipping and sales document to make it appear that the inventory was sold, not stolen. There's no risk of being caught stealing on site. The victim company unknowingly delivers the targeted asset. In order to hide the theft, the fraudster creates a false sale. In some cases, the fraudster simply lets the receivable age out on the books until it's eventually written off as uncollectible. It may take steps to remove the sale, understate legitimate sales so the accomplice is billed for less. One of the most egregious ones that I remember was the case of a person at a university, it turns out, who was buying new furniture for the offices at the university. And they also purchased furniture for their own home. So, they had couches and tables and stuff delivered to their house. But it was all mixed into this large purchase of furniture for the offices at the university. And because they had poor inventory control, they almost got away with it. They didn't because, as it turns out, a faculty member had just moved down the street from this person's house and recognized the furniture delivery truck bringing stuff into the person's home, who was one of the top people at the university. And it's like, I just saw that truck at the university delivering furniture, and now that they're home, that seems odd. And they had their furniture in their home paid for by the university. Okay, so as I say, what's good about that is you don't have to steal it at the university and try and get a couch into your car and bring it home. Just write it up so that it's delivered to your house. Pretty cool. All right, there's your flow chart on that. Other schemes. Employees can tailor their thefts to the organization, to their security systems, their record-keeping systems, to the building layout, to day-to-day operations, and then write off assets to make them available for theft. One of the things you should keep an eye on if you're an auditor is the scrap account. So very often, if inventory is deemed no longer saleable, you write it off as scrap. And what do you do with it? Well, we just pile it over there, and then we have somebody come and pick it up and take it away. Well, maybe it's still good, and you pile it over there, and when no one's looking, you bring your van by and you pick it up and stick it in the van. It's not really scrap. It was good stuff that was deemed scrap, so you could steal it. All right. Okay. How do you conceal that inventory shrinkage? Again, the term shrinkage we use is when inventory is less than what it should be. It goes back to agricultural goods, where you would say, place you harvested your corn crop and you put it into a silo and it fills it all the way to the top. Okay. Then when you go back a few weeks later, it's no longer at the top. Did somebody steal it? No. Some of the moisture escaped and the inventory shrunk. Okay, so there doesn't appear to be as much inventory as there was before because the corn has dried out. Shrinkage. Well, that works for corn. Doesn't work so well with, say, big screen TVs, when suddenly they were supposed to have 50 in inventory, but now you only have 45. And that would be the week after the Super Bowl. So So shrinkage should be red flag. It can be, just retail theft, shoplifting, or it can be, and often is, an inside job. It's a red flag. It signals fraud. Where did the inventory go? The search for an answer can uncover the fraud. So, did they alter the inventory records? Did they make fictitious sales and accounts receivables? Did they write off inventory and other assets? Were they physically padding the inventory so that it looked like they had more inventory than they actually did? Again, if you watch that Crazy Eddie videos, you'll see some examples of physical padding there. Okay. Number one, altered inventory records. Change the perpetual inventory record so it'll match the physical inventory. Okay. Called force reconciliation. Again, I'll refer you to the Crazy Eddie inventory, Crazy Eddie videos on that. So the perpetrator just changes the numbers in the perpetual inventory to make it match the inventory on hand. Result, there appears to be no shortage. Fictitious sales and accounts receivable. Okay, create a fake sale to mask the theft of the asset. Debit the accounts receivable or cash, then credit the sales account. Now you've got an uncollectible accounts receivable or you're missing cash. So the solution is you sell to a large client who may not notice and will pay the fake sale. So you steal some of the merchandise going off to that big customer of yours. They don't look at things closely enough and they just go ahead and pay it. Or you write off the receivable after an appropriate period of time. Write off inventory or other assets as obsolete. It removes the assets from the books before or after they're stolen. And as a result, there's no shortage. So you write off obsolete, and then you put it over at the corner of the warehouse to have some scrap company come by and pick it up. Well, it's still really good, and so you take it because it was deliberately placed there for you to steal. Physical padding. Most methods of concealment deal with altering the inventory records. Some fraudsters try to make it appear there are more assets present, such as empty boxes in the warehouse. You'll see that in the Crazy Eddie case. Or set up a wall of product where nothing's behind the wall. When you do auditing and you do an inventory count, inventory observation, you'll see, cubes of merchandise on pallets all around a warehouse. And they're going to hate you, but what you're going to have them do is pull down one of those cubes off of the racks and take it apart to make sure there's not an empty space inside it. Again, refer you to the Crazy Eddie video. Module 6, preventing and detecting those non-cash thefts concealed by fraudulent support. Again, how do you stop it? Separate the duties of ordering goods, receiving goods, maintaining perpetual inventory records, and issuing payments. Match invoices to receiving reports before you pay the invoice. Match packing slips to purchase orders. Monitor the increase in bad debt expense. Again, it might be a bad debt because it's a fictitious sale. Reductions to perpetual inventory should be properly supported. Reconcile materials ordered for projects, the actual work done, so they're not, what's the word I'm looking for? I can't think of it, but they're not requisitioning more goods than necessary to do the job and then stealing the excess. Periodically perform trend analysis on inventory designated as scrap. I mentioned that before, and then only remove assets with proper authority. Here's our big data techniques. We have a bunch of slides on that. Again, please take a look at them. There's some great stuff there. If you're going into the field of auditing a fraud examination, these might be some good slides to keep and ideas of using data analytics. Or if you take the data analytics class, these might help you in the class. Okay, and then that's the end